the United States just lost its last perfect credit rating. And yes, this could shake the global markets. Moody's, the last major credit agency holding out, has finally downgraded the U.S. government's credit score from 8AA to AA1. But before you scroll away, this matters more than you think. Will this crash your U.S. stocks? Will the U.S. dollar lose value? Should Singapore investors start worrying about their U.S. holdings, like ETFs or even USD savings? Stay with me till the end, because I'm going to break down why this downgrade happened, how it affects everyday Americans, and most importantly, what you, as a Singapore investor, should watch out for next. And hey, if you care about protecting and growing your money, don't forget to like this video and subscribe to Wealth for You, so the YouTube algorithm knows to show you more content that actually helps you invest smarter. Let's get started. Part 1. A quick background. For over a century, the United States wore its AAA credit rating like a badge of honor. It meant, you can trust us. We always pay our bills. 3 big agencies, S&P, Fitch, and Moody's, had all agreed. The U.S. was the gold standard in creditworthiness, but then the cracks started showing. S&P downgraded the U.S. back in 2011. Fitch followed in 2023. And now, in May 2025, Moody's has joined them, cutting the rating from AAA to AA1. So now, for the first time ever, none of the big 3 considers U.S. debt to be perfect. Still strong, yes, but not flawless. It's a symbolic moment, a wake-up call, not just for Washington, but for the whole world watching. Part 2. Why did Moody's downgrade the U.S.? Let's rewind a little. Imagine someone earning a good income, but every year they spend way more than they make. To keep going, they borrow, again and again. And now their interest payments are piling up. That's exactly what's happening with the United States. Moody's looked at the numbers and said, okay, the U.S. debt has crossed $36 trillion. And just paying the interest is getting more expensive because of higher rates. But here's the real problem. There's no clear plan to fix it. For over a decade, different governments, Republican and Democrat, have argued, delayed, and avoided tough decisions. No serious spending cuts, no proper tax reforms. So Moody's finally said, if the U.S. keeps borrowing like this, without a fix in sight, it may not be able to keep paying its bills down the road. And that's why they downgraded America's credit rating. Not because it's broke today, but because the warning signs are flashing and no one's really hitting the brakes. Part 3. What does this mean for everyday Americans? So what happens when a country's credit score drops? Think of it like your personal credit score. If it falls, the bank charges you more interest to borrow money. Same goes for the U.S. With this downgrade, investors may demand higher returns for lending money to the government. That means interest rates on mortgages, car loans, and credit cards could go up. For everyday Americans, that could feel like a higher monthly mortgage, more expensive car payments, and costlier credit card debt. And if investors start worrying about the U.S. economy, we might see more volatility in the stock market too, making people feel nervous about investing or spending. So even if they're not following bond yields or credit ratings, many Americans will still feel the effects, right in their wallets. Part 4. How does this affect Singapore investors? And what should you do? All right, let's bring this back to you. You're in Singapore. So you might be wondering, the U.S. just got downgraded, but how does that affect me? Well, if you've got U.S. stocks, U.S. dollar savings, or you're thinking about investing overseas, this matters. Let's break it down simply. 1. U.S. stocks. When news like this hits, markets can get shaky. Some investors sell in a panic, others take profit. So yes, we might see some short-term volatility in U.S. stocks, especially in broad ETFs like the S&P 500. But here's the thing. The US is still home to giants like Apple, Microsoft, Google. One downgrade doesn't change that overnight. So if you're investing for the long run, like 5 to 10 years, this is more of a speed bump, not a crash. No need to hit the panic button. 2. US dollar. Now let's talk about the US dollar, because a lot of Singaporeans hold USD or plan to convert it for studies, investments, or even retirement overseas. The USD is still seen as a safe currency, especially during crises. But here's what many don't realize. Over the years, it has been gradually weakening against the Singapore dollar. That's because Singapore's central bank keeps the SGD strong to fight inflation, while the US tends to borrow and print more money, especially during downturns. Now, with even more debt and this downgrade, the dollar could face more pressure going forward. So if you've got USD savings or you're planning to convert a large amount soon, watch the exchange rate. A small difference in timing can make a big impact, especially on large sums. And if your long-term goals involve spending in SGD, like retiring here, buying a home, or sending your kids to university, don't forget to factor in currency risk when planning your investments. 3. So what should you do as a Singapore investor? Here's the good news. You don't need to make drastic moves, but you do need to be smart. Stay diversified. If most of your money is in the US, consider adding Asia-Pacific, global ETFs, or other currencies. Don't put all your eggs in one basket. Be ready for ups and downs. If US politics brings more tax cuts or tariffs, that could shake up markets again. So stay flexible. Keep an eye on the USD, especially if you plan to convert it later for personal goals. Timing and planning matter. In short, stay calm, stay informed, and keep your investments balanced and future-ready. This downgrade isn't a disaster, it's a reminder. A chance to check in, make adjustments, and protect your financial future. Conclusion. So yes, the US losing its perfect credit rating is a big deal. But it's not the end of the world. Think of it not as a crisis, but as a wake-up call. A chance to pause, review your portfolio, and make smarter decisions going forward. Because successful investing isn't about reacting emotionally to headlines. It's about staying informed, staying calm, and staying consistent. If you found this video helpful, give it a thumbs up and subscribe to Wealth for You, where we break down global financial trends into simple, useful insights made for Singapore investors like you. And don't forget to hit the bell icon so you'll never miss our next video on investing strategies, market updates, and more. Thanks for watching. And as always, invest smart, not scared.